Welcome to this final explainer in our ASC 205 series. We've covered a ton of ground so far, everything from the two-part test for discontinued ops to the exact triggers for liquidation basis accounting. But knowing the theory is really only half the battle. Today, we're transitioning from just understanding the rules to actually executing them out in the real world. We're going to lock down the preparation, audit, and control processes that guarantee absolute compliance. Let's get to it. So here's our playbook for today. We'll kick things off with 5 foundational rules you can absolutely never break, then shift gears to auditor expectations, walk through bridging the gap between VAS and US GAAP, and finally, wrap up with your go-to period-end execution checklist. Right out of the gate, I want to talk about timing, because it's a huge trap. A lot of accounting teams treat presentation rules like a final checklist at the very end of the close. But honestly, you have to build compliance into the very beginning of your process. If you make a structural error early on, say missing a required statement altogether, and treat it as an afterthought, you're looking at massive, painful rework of literally everything downstream. Verify at the start. So before we even think about doing any detailed data entry or getting lost in the weeds of reconciliations, we have to stop and ask ourselves, what's the absolute minimum standard that must be met at every single annual and interim close? And to be clear, we aren't talking about best practices here. We're talking about non-negotiable baseline compliance. All right, let's dive into the 5 rules to never break, which set up that baseline compliance for our financial statements. Missing even one of these 5 steps means your statements are fundamentally incomplete. So let's break them down. Number 1, all 6 statements have to be present every single time. If you submit a package and it's missing, say, a cash flow statement, it's incomplete. It doesn't matter if your balance sheet math is flawless. 2, going concern has to be assessed at every period, not just at year-end. If conditions pop up mid-year, you can't just defer that assessment. When in doubt, assess it. 3, comparative periods must be consistent. Anytime you reclassify prior period amounts, you have to disclose the nature, reason, and amounts in a note. There's no, oh, it's just a small amount exception here. 4, discontinued ops require prior period reclassification. If a component qualifies this year, you've got to reclassify every prior period income statement shown. If you don't, your financials just aren't comparable. And finally, number 5, never apply the liquidation basis of accounting without a formal written assessment and manager approval. Remember, once you go into liquidation basis, it's irreversible. With those baselines locked in, let's switch perspectives. Let's step into the shoes of the ultimate reviewer and start thinking like an auditor to prepare for that final inspection. It's super helpful to see how the other side of the table operates. Auditors aren't just in there checking your math to see if assets equal liabilities. They're looking at things from a completeness and disclosure angle to verify if the actual framework is correct. For completeness, they want to see all 6 statements and check that the notes hit all required disclosures. For going concern, they're looking for a formal documented assessment using the exact required terminology. They aren't going to just take your word on discontinued operations either. They want to see that 2-part test fully documented, prior periods properly reclassified, and the correct held-for-sale presentation on the balance sheet. They'll also rigorously check your comparative periods for consistent structure, and if you use the liquidation basis, they'll verify that the strict trigger conditions were met and formally approved. So to survive that level of scrutiny, you need to be proactive. Have these specific documents armed and ready before the audit even kicks off. Seriously, don't make the auditor ask for them. Have your signed and dated going concern memo ready for the current period. Have your documentation for the 2-part discontinued ops analysis finished. Get your draft notes together with those reclassification amounts for each period. Visually confirm you've got all 6 statements, and have that written manager approval ready if you applied the liquidation basis. Proving your framework is rock solid from day 1 completely changes the tone of the entire audit. Okay, moving right along, let's look at the VAS to US GAAP conversion and see what this actually means for teams trying to bridge that accounting gap. If you're working with clients preparing financials under Vietnamese accounting standards, or Circular 200, you have to be incredibly careful here. The differences are massive. Under US GAAP, going concern requires a formal 12-month assessment with mandated disclosure language, while VAS is way less prescriptive. Look at discontinued operations. US GAAP demands a strict strategic shift test and separate income statement presentation. Under VAS, that's not even a defined concept. A disposal might not trigger separate presentation at all. It's the same story with the liquidation basis. US GAAP has a whole separate framework, which VAS just doesn't separately define. And while both require comparative periods, US GAAP is extremely strict about detailed reclassification notes. Because of these drastic differences, you can't just copy and paste the VAS presentation and call it a day for US GAAP. You have to actively bridge the gap by manually doing these 4 things. First, perform the going concern assessment purely under US GAAP criteria. Second, evaluate all disposals against the US GAAP 2-part test. Third, review the comparative period structure for absolute consistency and draft your reclassification docs. And fourth, independently confirm all 6 US GAAP statements are actually there, since a standard VAS format might combine or just omit things that US GAAP strictly requires. Finally, let's take all this theory and turn it into action. We'll go over the controls and the period end checklist you need to execute a flawless close. I want you to think about your specific role right now, because executing this perfectly relies on a really clear chain of command. Every single step is a vital safety check. If you're the preparer, your job is running the checklist, flagging going concern triggers, and spotting potential discontinued operations right away. If you're the reviewer or senior, you're the one reviewing that documentation, confirming the classifications, and rigorously checking consistency. And if you're the manager, you hold the final keys. You sign off on going concern, formally approve any liquidation basis applications, and review those audit-ready disclosures before they go anywhere. To make sure those roles actually function, these 3 key controls have to run at every single period close, both annual and interim. Control 1 is going concern monitoring. Review the triggers and document the assessment. And again, no deferring conditions to year end. Control 2 is discontinued operations identification. Actively confirm if anything was disposed of or held for sale, and run that 2-part test. Control 3 is the completeness and consistency check, verifying all 6 statements are present and comparatives line up perfectly before you hit send. And that brings us to your final tool, the period end checklist summary. Before any set of financials goes out, your team needs to literally check off every item here. All 6 statements? Check. Going concern assessment documented? Check. Held for sale separate on the balance sheet? Yep. Discontinued ops segregated on the income statement, including prior periods? Check. Reclassifications disclosed? Yes. Liquidation basis properly approved? And finally, has the ultimate manager's sign-off been obtained? You need a yes across the board. If you follow that checklist, you're going to be audit ready. So I want to leave you with one final thought to test your readiness. If your close starts tomorrow, are you truly prepared to build compliance from step 1? Don't wait until the absolute end to find a massive structural error. Verify early, document thoroughly, and lean on your controls. Thanks for joining me for this series on ASC 205, and best of luck with your next flawless close.